Somewhere between the stock market you follow on your phone and the bank where you keep your savings, there is a $3.5 trillion lending machine operating almost completely in the dark. It has no branches, no tellers, no deposit insurance. It doesn't show up on the nightly news. Most financial journalists barely cover it. And yet right now, it is making the loans that fund the companies that make your medications, power your software subscriptions, and employ millions of people in the middle market of the economy. It's called private credit, or sometimes direct lending or shadow banking. And in 2025 and into 2026, it is facing the most serious stress test in its short history. Today, we're going to pull back the curtain completely. We'll explain what private credit actually is, show you who's really running it, which industries and countries are most exposed, and, most importantly, why this could eventually matter to you, even if you've never invested a single dollar in it. Every claim in this video is backed by a source: the IMF, the Federal Reserve, the Financial Stability Board, or major financial institutions. This isn't speculation. This is the story hiding in plain sight. Let's get into it. To understand private credit, you first have to understand what happened in 2008. When the global financial crisis hit, regulators around the world decided that banks had been reckless. They passed new rules, things like the Dodd-Frank Act in the US and the Basel III International Banking Standards, that forced banks to hold more capital and dramatically reduce risky lending, especially to mid-sized companies. This left a gap. Thousands of businesses, not tiny startups, not giant corporations, but the companies in between, suddenly had nowhere to borrow money. They couldn't issue public bonds. They were too big for a simple bank loan, and the banks that used to serve them had been told to back off. Into that vacuum stepped a new type of lender: private credit funds. These funds, managed by firms like Apollo Global Management, Ares Management, Blackstone, Blue Owl, HPS, and dozens of others, raise billions of dollars from institutional investors, then lend that money directly to companies. No middle bank, no public bond market, just a direct loan from a private fund to a private company. According to the Alternative Credit Council and investment bank Houlihan Lokey, the global private credit market has now reached $3.5 trillion in assets under management as of the end of 2024, up 17% from the previous year. Let that sink in. $3.5 trillion. That is larger than the entire U.S. high-yield bond market, larger than the leveraged loan market. It has grown tenfold since 2009. Capital deployment, the actual money being lent out, grew to nearly $593 billion in 2024 alone, up 78% from 2023. But here's the critical thing you need to understand. This market operates almost entirely outside the regulatory framework that governs banks. There are no deposit insurance programs, no liquidity requirements, no real-time public reporting of loan values. And unlike a bank, if a private credit fund makes bad loans, there is no government backstop. Now here's where it gets interesting, and where most financial coverage stops too early. People think of private credit as a simple two-step process. Investors give money to a fund lends money to companies. But the real architecture is far more complex, and that complexity is where the risk hides. The money chain. Here's how the money actually flows. Step 1. Pension funds, insurance companies, sovereign wealth funds, and wealthy individuals invest in private credit funds. According to the Federal Reserve, public and private pension funds hold roughly 31% of all private credit fund assets. Step 2. The private credit fund takes that capital and lends it to mid-market companies, often those with revenues between $50 million and $1 billion. But here's step 3 that almost no one talks about. Those same private credit funds often borrow additional money from traditional banks to amplify their lending power. It's called subscription line financing, or NAV-based financing. The banks lend to the fund uses that leverage to make bigger loans. The IMF's October 2025 Global Financial Stability Report found that U.S. and European banks now have $4.5 trillion in total exposure to all non-bank financial institutions, a category that includes private credit funds. The European Central Bank's banking supervision arm has specifically warned about what they call layered leverage, where leverage is introduced at multiple points in the chain, at the level of the investors, at the fund itself, and at the portfolio companies the fund has financed. What this means in plain English, the banks that private credit was supposed to replace are now the primary financiers of private credit itself. The competitors became the clients. The disruptors became dependent on the very institutions they disrupted. And the Financial Stability Board, the global watchdog that monitors risks to the financial system, published a major report in May 2026 calling banks a critical node within the private credit ecosystem, providing multiple types of financing for working capital, leverage, and even synthetic risk transfers. This is the leverage on leverage problem that analysts have been whispering about, and it means that a serious shock in private credit would not stay contained inside private credit. So is there actually a problem right now, or is this just theoretical? Let's go straight to the data. The IMF's 2025 Financial Stability Report contains a number that should stop anyone in their tracks. Over 40% of private credit borrowers had negative free operating cash flow at the end of 2024, up from 25% in 2021. Read that again. Nearly half the companies borrowing from private credit funds are spending more cash than they're bringing in. They are staying alive by taking on more debt. PYMNTS.com, reporting directly from the IMF's findings, noted the IMF's own language. These companies are prolonging their reliance on payment-in-kind provisions and amend and extend arrangements. Interest coverage ratio measures a company's ability to pay interest on its debt from its operating earnings. The higher the number, the healthier the borrower. In 2021, the average interest coverage ratio in private credit loans was 3.2 times, meaning companies earned $3.2 for every dollar of interest owed. Healthy. Today, that ratio has fallen to roughly 1.5 times. Worse, 47% of private credit borrowers now have an interest coverage ratio below 1.5 times, compared to just 7% in the fourth quarter of 2020. S&P Global found that 11% of middle-market borrowers cannot cover their interest at all from operating cash flow. Average borrower leverage has risen to 5.1 times EBITDA, a measure of earnings, as floating interest rates surged alongside Federal Reserve rate increases. When a borrower can't pay the interest on its loan in cash, private credit funds have an escape hatch called payment in kind, or PIK. Instead of receiving cash interest, the lender simply adds the unpaid interest to the principal balance of the loan. The debt grows. The problem is deferred. In 2022, PIK arrangements accounted for roughly 5% of the private credit market. By 2025, that number had grown to 11%. But here's the truly alarming stat. Lincoln International, which values roughly one-third of all U.S. private credit portfolios, using data from over 225 asset managers globally, tracks what they call bad PIK, a PIK arrangement added after the original loan was signed, meaning the borrower encountered financial trouble and couldn't pay. In Q4 2021, only 36.7% of PIK arrangements were bad PIK. By Q3 2025, that number had jumped to 57.2%. A majority of PIK deals are now distress signals in disguise. There's cracks in the private markets, said the Lincoln International analyst quoted in coverage of the data. Officially, the private credit default rate in 2024 was reported at between 1.9% and 4.6% depending on the rating agency, but experts warn the headline number dramatically understates real distress. In February 2026 alone, Fitch recorded 11 default events, nearly double the 2025 monthly average of 5.9, and 7 out of those 11 involved the introduction of PIK interest instead of cash. Fitch estimated a 6.0% default rate as of April 2026, while Morgan Stanley estimated defaults could approach 8% in weaker economic conditions, and UBS outlined a severe downside scenario of 14 to 15%. Moody's found that debt exchanges, maturity extensions, and distressed restructurings, deals where terms are quietly renegotiated to avoid formal default, accounted for roughly 65% of private credit defaults during 2025. In other words, the system is designed to hide its own pain. Private credit is primarily a U.S. story. About 65% of all private credit AUM is invested in American companies. But the growth story is increasingly global. The U.S. is both the origin and the epicenter of the private credit market. The middle market, companies with $50 million to $1 billion in revenue, is the core borrowing base. And with default rates rising and PIK proliferating, the U.S. financial system faces the greatest direct exposure. The transmission chain, as a Quinn Emanuel law firm memo warned in March 2026, runs from technology companies through private credit originators to the regulated banks that lend to them, to the insurers and pension funds that invest alongside them, and potentially to the retirement accounts of ordinary Americans. The UK maintains approximately 35% of the European private credit market despite Brexit. A parliamentary inquiry into the growth of private markets published its findings in January 2026, with recommendations that UK financial regulators monitor private credit developments closely. The Bank of England launched a system-wide exploratory scenario exercise at the end of 2025, specifically to explore how private credit markets would respond to a severe economic downturn. Europe is now the fastest-growing private credit market in the world. Europe-focused private credit funds captured 46% of global fundraising in the first 3 quarters of 2025, nearly doubling their 23% share from 2024. The European private credit market reached approximately 450 billion euros in AUM by end of 2025. Industry projections suggest it could exceed 800 billion euros by the end of the decade. UK, France, and Germany remain the most mature markets within Europe, accounting for 46% of European deal activity. But Italy, Spain, and other southern European markets are rapidly opening up. The European Insurance and Occupational Pensions Authority, EIOPA, flagged private credit as a key financial stability concern in its December 2025 Financial Stability Report, specifically highlighting the exposure of European insurers and pension funds. Here is the dimension of this story that I find most troubling, and the one that directly affects everyday investors. For most of its history, private credit was only available to large institutional investors, pension funds, insurance companies, sovereign wealth funds. The minimum investment was often $1 million or more. Regular people simply couldn't access it. That has changed dramatically. Private credit managers have been rolling out what are called semi-liquid vehicles, structures like non-traded business development companies, BDCs, and interval funds, that allow accredited retail investors to buy in with far smaller minimums. These have grown from zero in 2021 to more than $200 billion today in the U.S. alone. The pitch is compelling: higher yields than bonds, monthly income, diversification. But the products carry a critical mismatch. The underlying loans are illiquid. They cannot be sold quickly. But the investment products offer quarterly withdrawal windows. When markets are calm, that works. When stress hits, it doesn't. In Q4 2025, investors in BDCs with over $1 billion in assets requested withdrawals totaling more than $2.9 billion, a 200% increase over the prior quarter. Several major firms have already moved to restrict withdrawals. BlackRock, Morgan Stanley, and Cliffwater faced redemption pressures in early 2026. Blue Owl, one of the largest private credit managers in the world, announced the wind down of one of its retail-facing BDC vehicles in early 2026, replacing quarterly redemptions with direct distributions following sustained redemption pressure throughout 2025. The hidden risk in these products is what the IMF has called stale and potentially subjective valuations. Unlike publicly traded bonds whose prices update every second, private credit loans are valued by the fund managers themselves, often quarterly. That means paper losses can be hidden for months before they show up in your account statement. The obvious question is, are we watching 2008 happen again? The honest answer is, probably not in the same way, but the risks are real and still building. Here's what's different from 2008. In the lead-up to the subprime mortgage crisis, banks were carrying 30 to 40 times leverage. Private credit fund leverage today is far more modest, typically 1 to 1.5 times. And unlike the securitization chains of 2008, where mortgages were bundled, repackaged, and sold in layers of CDOs, Most private credit capital is locked up in long-duration, closed-end funds that can't simply run for the exits. But the Harvard Kennedy School warned in a June 2025 paper, the growing interconnectedness between private credit funds and other financial institutions can amplify financial instability, as evidenced by higher correlation and network connectivity during stress. And the Financial Stability Board's May 2026 report concluded bluntly, private credit remains untested to a prolonged economic downturn and so warrants close attention. There is already a Wikipedia article titled 2025 to 2026 Private Credit Crisis, which itself is a remarkable signal of where this story has gone. The system is being stress tested right now in real time. So what does this mean going forward, and what should you watch for? For regulators, the IMF, the FSB, the Federal Reserve, the Bank of England, the ECB, and the EIOPA are all now watching private credit closely. Expect new transparency and reporting requirements. The Harvard paper recommended that regulators expand the regulatory perimeter to include significant private credit funds. For the economy, if defaults continue rising, particularly in healthcare and software, the businesses that employ millions of middle-market workers could face restructurings. Private equity sponsors, under pressure from their own investors, may accelerate company sales or layoffs to reduce debt burdens. For ordinary investors, if you own a pension, have a 401k, or invest in insurance products, you are almost certainly indirectly exposed to private credit. The insurers holding your life insurance policies now hold between $900 billion and $1.1 trillion in private credit assets, an increase of over 20% in 2025 alone. And if you're being offered a high-yield investment product with quarterly liquidity and private credit exposure, read the fine print very carefully. Those quarterly withdrawal gates exist for a reason. For the market, Morgan Stanley projected the private credit market could reach $5 trillion by 2029. That growth will continue. The question is whether it happens with better transparency and oversight, or whether it continues in the shadows until the next stress test forces the issue. Private credit is not inherently evil. It fills a real gap in the economy. Thousands of businesses got loans they genuinely needed and couldn't get anywhere else. Investors got returns that were genuinely better than bonds. But any $3.5 trillion system that operates with minimal transparency, self-reported valuations, limited regulatory oversight, and growing connections to the pension funds and insurance policies of ordinary people, deserves a lot more scrutiny than it has been getting. The IMF is raising the alarm. The Federal Reserve is watching. The Bank of England is running stress tests. The FSB just published its most detailed vulnerability report on this market in history. The question is whether the mainstream conversation catches up before the next crack in the system becomes something bigger. Now you know where to look. If this video helped you understand something the financial press isn't covering, share it with someone who should know. And if you want to go deeper on any of the sources cited here, all links are in the description. Private credit is not inherently evil. It fills a real gap in the economy. Thousands of businesses got loans they genuinely needed and couldn't get anywhere else. Investors got returns that were genuinely better than bonds. But any $3.5 trillion system that operates with minimal transparency, self-reported valuations, limited regulatory oversight, and growing connections to the pension funds and insurance policies of ordinary people, deserves a lot more scrutiny than it has been getting. The IMF is raising the alarm. The Federal Reserve is watching. The Bank of England is running stress tests. The FSB just published its most detailed vulnerability report on this market in history. The question is whether the mainstream conversation catches up before the next crack in the system becomes something bigger. Now you know where to look. If this video helped you understand something the financial press isn't covering, share it with someone who should know. And if you want to go deeper on any of the sources cited here, all links are in the description.